Hi there, Dan Kurz, DK Analytics. Thanks a lot for tuning in. It is Sunday, November 4th, 2018. We're coming back to you in a video format. I should also state, as I've already stated on the website, that posts and reports are going to be suspended pending the reset, which I expect, which will enable me to carry forward wider publishing activities relatively independent of financial concerns. With that said, let me dive right in. Today's video is going to focus on rapidly rising IT costs and their implication, GE as corporate America's somewhat sad and disastrous poster child, and last but not least, a recession's bottom line impact. Let me dive into rapidly rising IT costs. The long-held adage of storage being basically free is increasingly going by the wayside. This basically means that the cost of computational growth, including AI, blockchain ledgers, etc., will start to rise aggressively. As Kreider's law, in essence the corollary to Moore's law, Kreider's law being free storage associated with ever more capable hard drives, right? And Moore's law, I met the great man myself a couple times. It was an honor, but his law, more importantly, is that the number crunching power has roughly doubled for the same money in less than 2 years, thanks to sustained transistor advances, circuitry ever tighter together. Both of these laws that have unleashed and sustained the IT revolution and the productivity that's been derived from it are breaking down. On the adequate and free storage front, from a website that I suggest you go take a look at, the website's name is blog.dshr.org, blog.dshr.org. Seagate, obviously a kingpin in hard drives, subscribes to IDC's estimate that around 13 zettabytes, this huge, or 100 zeros, or I don't know, some huge number, out of 44 zettabytes by 2020 would be critical to keep stored, but at the same time, Seagate subscribes to the theory, given the breakdown in Kreider's law, that there will be, by 2020, a shortage, a storage gap, a data capacity gap of around 6 zettabytes, all right? That would be a 14% shortfall with clear implications as concerns possibly surging data storage costs. Upshot, AI, blockchain, a quote, Terminator-like unquote takeover by machines. This might be a reality check, Earth calling Mars. By the way, I went into, and back to planet Earth here, I went into considerable detail on this and blockchain's technology and its impossible energy consumption footprint in post 23, whose title is Precious Metals versus Cryptos, right? So back here on planet Earth, forget the Terminator machines for a moment. I say that only half in jest, but a lot of people are out there fearing that humanity is going to be enslaved to machines, and I like to bring forth a bit of sanity into this, and that's what this is about. And it also obviously has huge, huge productivity implications, but I'm getting ahead of myself. The irony of all this is, of course, that the slowdown in Kreider's law and in Moore's law means that data itself and the processing of that data is not creating the productive value to pay for itself. In other words, the value of incremental data and the information it is delivering is becoming increasingly marginal. This is not only a problem for AI and blockchain ledgers, which feed on data, but also for productivity more generally. Why? With a gap widening aggressively. That is, the cessation of Kreider's and Moore's law and the unbelievably low and ever lower storage and computational costs starting to end and reverse, GDP growth will also be impacted. Why? Because the IT advances have been, despite all the misallocations and the cronyism and the QE, they have been what has allowed economies to carry forward any semblance of increasingly meager productivity growth. My point, this suggests that as this breaks down and IT no longer pays for itself, we're not only going to hit a lot of constraints there and price increases of IT, but we're going to need progressively lower interest rates, even though creditors are going to demand higher ones for both default and monetary inflation reasons. So a digital fracking boom, and I say that as a takeoff based on the fracking boom in oil, which never made any economic sense, right? But was hyped and paid for by external capital and had this massive destruction of the funds given to it. This might be what's going to beckon in the IT space to overcome declining IT productivity. So we're going to add another arrow into the quiver aimed at declining global productivity. And this does not even address the energy impossibility of blockchains, power junkies, not just AI, but blockchain power junkies, which in less than a year, or roughly a year, in aggregate, are on track to reach Denmark's entire energy consumption, especially when we consider the fact that affordable 24/7 dense energy, note where all these servers farms are. They are close to atomic power plants. They are close to big coal power plants. They tend to be in China. They tend to be where dense energy, which is 24/7, relatively affordable, is available, all right? But as this too becomes increasingly difficult and expensive to extract, as I've detailed in posts that are there for your examination, that will add insult to injury. So to conclude on this growing IT cost challenge, talk about a patently unsustainable business model. Talk about even more economic and profit growth headwinds in a global economy already facing incomparable debt, both in absolute and percentage of GDP terms, financial repression-induced misallocations, as stated, and the related collapse in productivity growth from all that ugly stuff. Now, even decades of IT, that is now mean going forward, this is the new dynamic, decades of IT productivity tailwind threaten to turn into IT headwind. And this will add insult to productivity growth injury, and with it, take global growth prospects down another notch. Speaking of long sputtering growth, GDP growth, real growth, and nominal, GE, I'm going to say, is corporate America's poster child, as is IBM. I think it is a preview, unfortunately, of widespread coming attractions, and here's why. But first, a bit of history or backdrop, if you will indulge me. GE has been in the news again in a negative sense. Again, Wall Street's and the C-suite's LBOing of America, underwritten by the Fed, has fleeced Main Street. In this sense, it's financial engineering and M&A over organic growth. And again, as I hope to share with you, GE's trajectory here is threatening in the sense that there's a lot of copycats out there, right? I grew up in a GE town, Schenectady, New York, which is also GE's hometown. What's long been going on with GE is too close for comfort, but also entirely predictable. After Neutron Jack, only the buildings were left standing in Schenectady, New York, and M&A Immelt took turns charcoaling GE's industrial product portfolio for approximately 30 years in favor of far sexier, instant gratification, especially for management compensation, financial engineering, and M&A versus grinding it out as industrial America used to in the realm of brick by brick, no shock and awe, product arena competitiveness. The price of Neutron Jack and M&A Immelt's 3-decade-long malfeasance perpetrated against GE shareholders and GE employees. In an all too familiar story, top management massively enriched itself. Case in point, the last GE CEO got over $4 million severance package for dragging GE even deeper into the ditch. And all this while the company has continued to flounder and might even face illiquidity or bankruptcy at some point. This floundering is attested to by multiple rounds of multi-billion-dollar write-downs, most recently a staggering $22 billion write-down. No matter how much income smoothing and P&L and balance sheet lipstick top brass has smeared on this sick, ugly pig they had created over decades, they couldn't hide the travesty that they had created. In other words, the truth will out, and it has. GE, an American business icon and an original 1896 Dow component, was founded in 1892 by none other than J.P. Morgan, Anthony Drexel, and the famous inventor Thomas Edison, and was kicked out of the Dow this past summer, in the summer of 2018. Worse yet, after a 119-year-old dividend payment is history, GE's dividend has been chopped to the bone, clocking in at 1 measly cent per quarter. The takeaway? Eventually, GE-style mismanagement, corporate malfeasance, C-suite corporate malfeasance will catch up with the stock price. That's the message, and that's what we've been seeing as GE disintegrates. IBM, are you listening? Standard & Poor's 500, are you looking over your shoulders? Or are the C-suite mega million-dollar compensation managements rather of the opinion, frankly, my dear Watson, I could give a damn because I've already made my 10, 20, 30 million. You know where my suspicions lie, sadly. Well, these are the collective fruits, I would argue, of fiat money-enabled cronyism. Corporate America is corporate anorexia, C-suite decadence and arrogance, a destructive litigation and regulatory environment which has been financed by financial repression. But it is the big companies, the Standard & Poor's 500 companies, that can handle financial repression and the resulting regulatory and litigation environment best, because they have the staff and the lawyers to contend with it, to drive smaller competitors out of the business, and to make huge monies thanks to their ties to big government, i.e. crony capitalism. After a decade, turning to corporate America in a broader sense, and again, GE being the poster boy of what's wrong under the corporate American hood in, I'm afraid, too many instances, after $4 trillion spent, that is based from cash flow and proceeds from massive new debt, corporate America has committed itself to, in essence, shrinking its shareholder base. So those $4 trillion plus spent in the last decade to buy back increasingly overvalued stock, to maximize the value of the C-suite's massively outsized stock options awards even further, of course, corporate America is running out of sustainability tarmac. Instead of having adequately invested in organic growth over the past decade, America's global product competitiveness looks more imperiled. How so? Via the perpetual and now expanding $600 billion plus net trade deficits, that is, as they depict. Now, some of you will say, well, the dollar's been strong. Well, America's trade deficit has been rising whether the dollar is strong or weak. And there's a strong argument to be made, as I've made in past publications, that German and Japanese companies long did very well in terms of exports, and so did those countries in terms of trade surpluses with very strong currencies. So please, let's not go into that currency strength arena as an excuse. It just doesn't cut any mustard, especially not when we consider that the U.S. currency against a basket of foreign currencies is substantially weaker than it was 30, 40 years ago. But back to onto the main road. The perpetual and now expanding $600 billion average net trade deficits, goods and services, depict the degrade that corporate America earns in terms of product competitiveness. Let's just be honest. And the accumulated $8.6 trillion net debtor position is, in essence, the snapshot of all these deficits, or the cumulative lacking global product portfolio competitiveness of Standard & Poor's 500 companies by and large. And as a result, this casts a long shadow. And I'm suggesting that GE is the poster child of what's gone wrong and what could continue to go wrong. Let me get on to that. This corporate anorexia, or sustained cost and personnel cuts, not just for productivity, not just for capital replacing machines, but in essence to shrink the business and buy back in stock with financial engineering low interest rates. This cuts in to the meat, the bone even, right? Overseas outsourcing, sustained costs and personnel cuts. It diminishes the corporate muscle at the very least, and American manufacturing prowess and even R&D capability. Yet it has led to unparalleled riches, the widening chasm between haves and have-nots for the C-suite. It has been, more importantly, for society, for American society, it has been at the expense of, and the American economy, it has been at the expense of generating long-term value, sustainable differentiation in products, and thus organic growth in the arena of globally competitive products. That's what counts at the end of the day, right? This will eventually leave even deeper skid marks. And GE, again, in my view, is a sad preview of coming attractions, of coming corporate America attractions, in my view, specifically via poor corporate America product competitiveness via higher interest expense in the pipeline, via a higher fixed cost structure related to much more leveraged balance sheets, and via much greater exposure to rising interest rates. Note that while corporate debt is up, corporate U.S. debt is up 82% during the past 10 years, namely from 3.4 trillion to 6.2 trillion, the current interest expense at about $25 per S&P 500 share is actually half of what it was a decade ago. So you've got net debt up over 80%, interest expense down about 50%, thanks to plummeting interest rates engineered by financial repression, global QE, global ZIRP, and even NIRP. Now, imagine what will happen during a reversion beyond the mean, that is, a secular bond bear market, to borrowing costs and to an S&P 500 EPS residual that could easily face a $50 plus interest expense, a doubling. When you look at this and compare it to a 12-month move in GAAP S&P 500 GAAP EPS of 129, that would be pulled down by 19% just if we had interest expenses move up, not to extreme levels, but to relative pedestrian levels in terms of the average over the last 100 years. Plus, and this is very important from an animal spirits perspective, the debt-encumbered corporate balance sheets will limit organic growth initiatives. You don't bet an encumbered ranch, whether in R&D, CapEx, or training. You can't. You pay creditors. And you know what else you do? You do secondary offerings of stock prices that are a fraction of the bubble levels we have, which just adds even more injury to copious insult at the shareholder level. In aggregate, what this means is that, in my opinion, corporate America will not be optimally positioned to sell more wares overseas, despite what should be an increasingly weak dollar in the years ahead. Needless to say, this will negatively impact U.S. jobs, U.S. productivity, U.S. economic growth, and U.S. inflation. 1970-style stagflation revisited, but from still near record low bond yields and lofty PEs, I dare say that's a real risk. In fact, I think it's nearly a given. Translation: Wall Street's quasi-LBOing of big cap America has fleeced Main Street and cut into the bone of America's future GDP growth, which is why litigation reform will be so important. And you know Trump's stance there. He is big time into litigation. So sadly, don't look for litigation redress from this White House. As an example of what I'm referring to, why litigation reform is so necessary, note that Monsanto/Bayer got hit with a $300 million decision by a jury for a man that suffered from cancer that had only been using Monsanto's Roundup for a short period of time. This is why litigation reform is so important if America is to fully open back up for business. And American litigation costs are roughly 2.6 times the European level, as I have addressed in prior publications. This is also why lasting regulatory reform, cutting the crap out of the size of government, the bureaucracy, not expanding it, Mr. Trump, will be more vital than ever for the very entrepreneurs and small businesses that will be needed, as always, to bring the American economy back to better organic growth numbers. So both litigation reform and regulatory reform will be pivotal to, in essence, offset and more the the malfeasance of Standard & Poor's 500 company behavior in aggregate, focusing on stock buybacks and M&A instead of grinding it out. Not so sexy, not shock at all. Investment in new product competitiveness, which, as I mentioned, the trade deficit, which is huge, 600 billion for roughly 14 years on average and growing, suggests that America gets an utterly failing grade there. The de facto LBOing of big cap America is also principally why year-to-date GAAP Standard & Poor's 500 EPS of nearly $129, that is 12-month moving per the third quarter. That is why S&P 500 GAAP earnings per share is up through Q3 18 by 20.3% year over year. Obviously, a starkly lower effective tax rate combined with tax-advantaged repatriation of overseas profits that allowed the S&P 500 companies to take excess cash reserves at a low tax rate and that were technically parked overseas. They're actually invested in U.S. Treasuries, T-bills, and use them to repurchase even more shares. This has fueled these two things, a starkly lower effective corporate tax rate and the tax break on profit repatriation, the liquid kind. This has fueled this stark late-stage EPS surge. But the surge is a Potemkin Village EPS growth surge, not an organic one, and not a sustainable growth one. It is the ugly side of the S&P 500 LBO stub that the nation has to work with going forward. A stub which will, as said, not only prevent greater product competitiveness in terms of the balance sheet, but will add insult to injury by, in essence, having corporate chieftains and the chief financial officer issuing lots of shares at much lower prices to rebuild the balance sheet, which will be a 1-2 punch for shareholders. This is really what we're trying to communicate here. And we say this not to be negative, just to try to be realists. And again, we juxtapose it against an S&P trading for 22 times bloated EPS very late in a business cycle that has been extended artificially and is roughly a decade old. Speaking of the business cycle, and there it is, that darn business cycle, which has been rendered academic. And in fact, we've made even more misallocation mistakes than before, given the financial repression worldwide that we've seen in an unprecedented manner. I have stated and written multiple times that after-tax profits typically sink by 40 to 60% in a plain run-of-the-mill recession. Recall, if you will, that EPS residual, it is just that, a residual. It's typically 3 to 8% of the top line. So if you were to sell $100 or had 100 in sales or revenue, your net profit would be $3, between $3 and $8. If the top line comes down just a smidgen, 2-3%, let's say, that bottom line, that EPS residual, typically bears a similar brunt, right? Costs take longer to cut. Here, the law of small numbers goes to work. A 3 to 8% net profit line / EPS line gets clocked, cut in half or more by just a small decline in the top line. That's what always happens. This is then aggravated by big bath accounting or Johnny-come-lately C-suite confessions about understated costs and write-downs of continuing business line operations. Meanwhile, and to underscore this, recall that when S&P 500 GAAP EPS peaked in 2006, at 81.51 per S&P 500 share. It took 5 years until 2011 for S&P 500 GAAP EPS to exceed the '06 high. And GAAP EPS growth from the '06 peak to 17 was a lousy 2.8% per annum. In nominal terms, that's an average rate, all right? From '06 to the current 128.8%, I'm sorry, the current $128.80 S&P 500 EPS residual, from '06 to the current 18 EPS number, we had a 3.9% compound annual growth rate on average. So barely exceeding the nominal GDP growth over the same period, if at all. And this, and here's the takeaway, and this despite all the buybacks and M&A fireworks, right? Heaven help us if we don't have stout product portfolio competitiveness going forward. Or perhaps those lousy 2.8% average per annum growth numbers, or 3.9 from '06 to 18 of the Standard & Poor's 500, are because of all of this distraction and enrichment beyond belief of the C-suite. For substantial detail, have a look at Post 25, interest rate impact on S&P 500 valuation and the energy disconnect. That's the title, Post 25, interest rate impact on the S&P 500 valuation and the energy disconnect. Now let's look at some numbers. If the GAAP S&P 500 EPS were to crater by, say, a conventional 50% from the current $129 GAAP EPS number, the S&P 500 EPS would collapse to 64.40 per share. Contrast this with the current S&P valuation of 2,723 on Friday and a current PE 12-month GAAP number of 22, which would jump to a 42.3 multiple, a PE of 42 times, if earnings were cut in half. Obviously unsustainable, nosebleed kinds of valuations. That is especially true when we consider the likelihood of substantially higher interest rates, thanks to today's much greater insolvency risks and monetary inflation concerns. To get out of debt, they will print endless amounts of money. History shows this. Those higher interest rates, due to higher insolvency and monetary inflation fears, and they are tied at the hip at the end of the day, those higher interest rates will push down the net present value, the market caps, the enterprise values, even further than a 50% EPS haircut would result in. In other words, we're going to have collapsing PEs. This is all the more true if we look at the hugely leveraged state of balance sheets compared to 10 years ago, which points to an outsized reduction in the equity portion of the enterprise value, right? That's kind of the shock absorber. If you take net debt and equity, your enterprise value, you're going to not be able to reduce the value of the bonds. Those have to be paid unless you declare bankruptcy. So the big hit in a leverage sense is going to be in the equity. That is, share prices are even more susceptible to a very big downdraft than if it was principally an equity finance balance sheet. For flavor, consider paying a historical PE of 16 times. For flavor, I mean dial these dynamics in, 50% less earnings, S&P 500 GAAP EPS of $64, $65 instead of $128 or $129, and look at it from a lower PE perspective. But first, let's just stay with a PE of 16. If we get a PE of 16 and we multiply that times EPS of 64.40 for the Standard & Poor's, an S&P of 1030 results, right? That's quite the downdraft from today's 2,700. It would be a 63% decline. These aren't wild and woolly speculations about coming EPS compressions. They're just basically history that's going to repeat itself. But wait, it gets even testier and more dangerous in terms of capital preservation. Let's say, again, honing in on the interest rate, the discount rate impact on net present values. Let's say, given that bonds and stock valuations travel together, as I've shown multiple times and posed, that they are both, in essence, net present value manifestations, bonds and stocks, of benchmark interest rates. We could, given what I just said, much higher insolvency and monetary inflation risks, we could see a rise in benchmark interest rates / discount rates, which are based on a leading the 10-year Treasury plus a premium because stockholders only get what's left after everyone else lines up for lunch. We could see PEs in the single digits. In other words, we could see a 70s style stagflation, or worse, repeat. Now, let's say we have a 64.40 EPS residual with the Standard & Poor's 500, and let's attach a multiple of 9 instead of 16. That would yield an S&P 500 of 579, which would be a drop of 79% from our current over 2,700 level. Just saying. Finally, given the fact that we're likely to find ourselves trapped in much more difficult economy than before, given all the corporate, or given the public policy stew, i.e. more redistribution, more third world amnesty, and an incredible amount of misallocations, declining dense energy availability or much higher costs in extracting it from the ground, and even still insane litigation in the US and global regulatory environment, we could well see an S&P that reflects both the lower organic growth rate perspectives that I mentioned and a much, much higher discount rate. And to add one other layer of insult to injury, we could actually, if the current trajectory pursued by the Republicans, and God, I hope they get in on Tuesday, don't get me wrong, but they're doubling down on growing government, on redistribution, and in fact on cronyism. And they're selling it as free market capitalism. If they fail and socialists take over, it's going to get even worse, tax-wise, litigation-wise, than it already is. And we don't have a strong product portfolio to throw at all this, right? So we could, in fact, have much lower valuations of stocks than in the stagflationary 70s, meaning single-digit PEs with earnings power that doesn't resurrect very quickly from a smashdown to half of today's level. That's would comprise an EPS nuclear winter, at least in real or inflation-adjusted terms. Speaking of which, the next video will delve into something called the DuPont decomposition of return on equity. That is, how do corporations achieve return on equity? And it's going to be a story on margins and turnover and leverage, and how all these things suggest it's going to be a tougher hoe ahead. Add that to the framework that I've tried to present here, It's not a pretty picture, and it could add additional headwind to a return of even 3% or 2.8% or 3.9% S&P 500 EPS compounding from 06 to 18. We're only looking at under 4% nominally. That could look good going forwards. All right. The caveat is an extraordinary, deep, and lasting reduction in earnings power would usher in a stouter growth rate from a very small base, law of small numbers. But that too would be nothing to hang one's hat on, especially if it took a decade to return to what I'll loosely call peak Standard & Poor's 500 EPS of roughly $129, $130 per share. Hope this gives you all some allocation food for thought. And by the way, as misery loves company, the described and obvious C-suite malfeasance enabled by financial repression, in a nutshell, crony capitalism, isn't unique to America, even though America has been in the pole position here for wretched excess on so many fronts, from corporate compensation, vulgarity, to leveraging up the balance sheets of corporate America, to the gills to litigation insanity. Makes you ask what happened to all the mature adults interested in their progeny, you might ask. America has exported these quote-unquote poisons elsewhere to varying degrees. So America's excesses and valuation challenges and organic growth challenges aren't in a vacuum, but it is the most drunken sailor on board as its huge and sustained net deficits, goods and services deficits of huge magnitude and huge net debtor position clearly show. You've got Switzerland, the UK, to a degree Japan, that have mimicked some of these less than adult-like behavioral modes of American government, American central bank, American corporations, not to mention the lawyers in this country. But if we turn to the equity valuation aspect, we are entering, to set all that aside, we are entering what looks like a 37-year, well, the end of a 37-year-old bull market in bonds. If all that other stuff, litigation, regulation, the political constraints, leave you cold or saying, okay, been there, done that, it's not going to matter, then do consider what a reversal in the global bull market in bonds will bring in valuation terms. That is very real, and at the end of the day, that will be the most important thing. And those rising interest rates will, in fact, reflect the malfeasance and the misallocations and the declining availability and affordability of dense energy, and thus productivity and earnings power and all that other good stuff. So we could be facing a long period of rising interest rates with much greater than average default and monetary inflation risks. We know why, and we also know that once the tide turns and all of a sudden everyone agrees to admit that the emperor wears no clothes, this stuff can happen quickly. That is, valuations can quickly shift. We don't have long bear markets. That is, they could be long in length, but they happen relatively quickly, historically speaking. What's the takeaway? The time for appropriate reallocation of investable funds might be quite short. That's it from here. I hope you get something out of this in terms of your investable funds, your portfolio structure. Thanks a lot for tuning in. I wish you a pleasant new week ahead. Bye-bye.